Hello and welcome to today's video. Before I start, I want to once more wish happy holidays to everyone and officially happy new year. I will kick off 2026 with latest earnings and earnings call from retail player Nike, which is interesting for me since price action is not favorable for them last couple of years while the markets in general feels overheated. But before anything, let's see what kind of progress have they made, if any. If you are looking for a solid broker for investing, I use interactive brokers for investing, low fees, global market access and great mobile app. By using my referral link, you can earn up to $1,000 in their stock and I can earn up to $200 per referral. Link is in the description of this video. So without further ado, let's start. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. So, over the past few months, I have spent a significant amount of time covering Lululemon, mainly because I found the stock trading at increasingly attractive valuations. Today, however, I'm shifting the focus to Nike. At least from my perspective, Nike's share price has been stuck in the same range for quite some time, which makes the latest earnings particularly interesting to analyze. Second quarter revenues came in at $12.4 billion, up 1% year over year. Wholesale revenues were $7.5 billion, representing an 8% year over year increase, while Nike direct revenues declined to $4.6 billion, down 8% compared to last year. Gross margin was reported at 40.6%, reflecting a decline of 300 basis points, and diluted EPS came in at $0.53, down 32% year over year. What stands out to me is the contrast between Nike and Lululemon when it comes to regional performance. Lululemon's challenges are primarily driven by slowdown in North America, while China continues to show strong growth potential. With Nike, the situation appears to be reversed. Naturally, growth rates are lower in percentage terms given Nike's much larger scale, but the directional difference is still notable. One of the biggest blemishes in the numbers was the performance of Converse. Revenues from the segment declined by sharp 30%, driven by weakness across all geographic regions. Another interesting point is Nike's effective tax rate, which stood at 20.7%, significantly lower than Lululemon's rate of roughly 30%. On the balance sheet side, inventories were reported at $7.7 billion, down 3% year over year, while cash and cash equivalents totaled $8.3 billion. During the second quarter, the company returned approximately $598 million to shareholders throughout dividends, marking a 7% increase compared to the prior year. This continued commitment to shareholders' returns adds an important layer to the broader investment case, especially when viewed alongside valuation and longer-term price dynamics. Now on to their earnings highlights, to be specific what's working and what isn't. So first, what's working. So wholesale continues to be the key source of strength, particularly in North America. The company delivered over 20% wholesale growth in the region, driven largely by existing partners, signaling improving confidence and healthier inventory positioning. North America revenue grew 9% in Q2, supported almost entirely by this channel. Football is emerging as a clear bright spot. Booking units are nearly 40% higher than during the 2022 World Cup cycle, reinforcing management's confidence in product relevance and demand. To support this momentum, Nike plans to refresh more than 100 Nike direct stores and 1,400 partners locations globally, backed by increased marketing investment aimed at re-energizing football consumers. Management also reiterated that margin expansion is a top strategic priority. While the recovery will take some time, leadership emphasized a visible path back toward double-digit EBIT margins. Importantly, when adjusting for the impact of new tariffs, gross margin expansion would already be positive in the third quarter, suggesting that underlying operational improvements are starting to surface. Now on to more critical stuff, and that's what's not working. So the pressure on Nike Direct remains significant and widespread. In North America, Nike Direct declined 10% in Q2, with Nike Digital down 16%, offsetting much of the strength seen in wholesale. Despite revenue growth, EBIT in the region still declined 8%, highlighting the margin cost of the channel imbalance. Internationally, the picture is more challenging. So Europe revenue declined 1% with EBIT down 12%, reflecting ongoing softness across digital and physical stores. Greater China remains the most concerning region, with revenue down 16% and EBIT falling nearly 50% over year. Digital performance in China particularly weak, declining 36%, underscoring demand and engagement challenges that are not yet stabilizing. Latin America part also continued to wait on results, with revenue down 4% and EBIT declining 15%, pointing to broad-based international pressure rather than an isolated regional issue. Looking ahead, management guided for Q3 revenues to decline in the low single digits, with modest growth in North America partially offset offset by continued weakness in Greater China and converse. Gross margins are expected to decline by 175 to 225 basis points on a reported basis, largely due to the higher product cost tied to new tariffs, while SG&A expenses is set to rise modestly as Nike increases demand creation and sport-focused investments. Now on to most exciting part of this video, valuation. When looking at the price to earnings ratio over the past 10 years, Nike is currently trading at PE of 26.6. The 10-year average sits at 40.6, which implies roughly 34% undervaluation relative to its historical norm. On a price to sales basis, the disconnect becomes even more pronounced. Nike is currently valued price to sales at 1.85, which is the lowest level seen over the last decade. With the 10-year average price to sales at 3.82, this suggests close to 51% upside if the stock were to revert toward its long-term multiple. Lastly, price to operating income also points to undervaluation. Nike currently trades at price to operating income of 23 compared to a 10-year average of 31, implying approximately 26% undervaluation based on the operating profitability. Taken purely throughout the lens of operating metrics, the stock appears clearly undervalued versus its own history. However, valuation alone is not enough. Despite these attractive multiples, this is not an accumulation zone for me. The company's struggles are justified based on the latest earnings and call highlights, particularly persistent margin pressure and ongoing weakness in China. And still, I don't see clear growth directives. These issues are not short-term noise and will likely take multiple quarters to resolve. Where I would start to get genuinely interested is if the stock were to trade below $50. At that level, Nike would be trading at the cheapest valuation it has ever seen based on the operating metrics discussed above, offering a far more compelling risk-reward setup once fundamentals begin to stabilize. So I need price below $50 and I need to see some directives of the future growth. So on the price action, the stock price relative to earnings and briefly touched the $70. Following the earnings release, the price sold off at the time of writing is trading around $60, which places it near the lower end of the Bollinger Bands. While this pullback has improved the risk to reward profile, the stock is still roughly $10 above my primary zone of interest. Okay, this is it for today's video. If you want written article on this topic, check my Substack. Also, for more daily insights and market updates, check my X account, and for more educational content, you can check my website. Like, subscribe as a sign of support, and see you in the next video. Bye.